Hey there, future homeowners. Welcome back to our series. I'm Lisa Pinnock from Lisa Does Loans and the Mortgage Dream Team with UFFC Express. Today, we're diving into the nitty-gritty details of something that might sound a little bit intimidating, escrow and prepaids. But don't worry, I'm here to break it down for you in very simple terms. First things first, let's talk about what exactly escrow and prepaids are. When you buy a home, you'll often hear these terms thrown around, especially when discussing your mortgage payments. Escrow is essentially a separate account held by a third party. When you put down your earnest money, that is held in escrow, typically by the title company, until the home closes. So escrow just means someone is holding this money for that purpose. What can confuse people is that we use that same word, escrow, after closing as part of your mortgage payment. Remember, escrow still just means this money goes into this account for that specific purpose. But in this case, it's the money that will be used for your taxes and insurance. There's also escrow for things like repairs or anything that would need to be held separately for accounting purposes that is related to your home or this transaction. Now, prepaids are exactly what they sound like. Expenses that you pay in advance. You prepay. The day of closing, the prepaid items will be collected and paid on your behalf. The first year of insurance is the most common prepaid item, so when you get your keys to the home, you can be confident that your first 12 months of insurance is in place from day one, and it's paid through the first year. Prepaid interest will be collected from the day of closing until the beginning of the next full month that interest will accrue. So, how does escrow actually work? Let's break it down step by step. When you close on your home, you will make an initial escrow payment as part of your closing costs that will begin that escrow account. The escrow is your money being held in this account to pay the bills for those escrowed items when they come due. This initial amount you pay on the day of closing will set up your escrow account. This initial escrow payment is based on estimates of your annual expenses for things like property taxes, insurance, and the amount held will depend on the time of year that you are closing versus when the bill comes due. Once your escrow account is set up, you'll make monthly payments towards it as part of your mortgage payment. Each month, 1/12 of the full amount needed for the full bill is collected and put into the escrow. Let's take a look again at the parts of your monthly payment. P, the principal. This is your loan amount and it moves down as it's being paid off. I, the interest is fixed in most cases and will not change for the term of the loan. T, taxes are subject to the county that you live in. And I, insurance. This is the only controllable expense. Insurance can change year to year, so it's a good idea to get quotes from other companies from time to time if you are seeing rates increase. Just make sure that you get quotes from an A-rated company for the correct coverage. We'll have a video about that in an upcoming segment of this series. Taxes, insurance, and any other escrowed line items are held in that escrow account, and you pay 1/12 of the estimated balance each month as part of your payment. That amount is held in this escrow account so that when the bill is due, the money is in there to pay it. These bills are paid by the mortgage servicing company, even though you may get a bill for your information. Here's where things get interesting. Escrow analysis. Every year, your lender will review your escrow account to make sure that you're paying the right amount to cover your expenses. If there is a shortfall, you may be required to make up the difference. On the flip side, if there's an overage, you may receive a refund or have your monthly payments adjusted. It's important to know that the escrowed portion of your payment will change, but it will change at the speed of the third party that is doing the billing. For instance, on the property tax, it's assessed on a cycle, so it may be a year or two before it's assessed. And when it is, it will likely go up. The escrow won't change, though, until the bill comes due. So that's when the escrow analysis will impact you. The escrow account may only hold a small amount more than what the expected bill is by law. So even if you ask the servicer to hold that overage, they aren't allowed to. So my recommendation is that if you are given a refund for an escrow shortfall, don't spend it. Either apply it to the principal or put it in your account and hold it for when the bill does come due. That way you aren't caught off guard with a big increase without the money to cover it. The escrowed portion of your monthly payment is the only part that can change on a fixed interest loan. So remember what I said about insurance? Get quotes when it's going up. And you can call me if you need help with this. Like I mentioned, we'll have a video about this coming up later as well. So why do lenders require escrow and prepaids? Well, it's all about protecting that investment, our investment and yours, by ensuring that your expenses are paid on time. They're helping to protect the value of your home and their financial interests. Let's take an example. The insurance bill was due on June 1st, but the mail ran late and the insurance company didn't receive it until much later. The problem is there was a house fire on the day that the house went under suspension. Is the insurance company going to honor a policy that has been suspended for non-payment? The escrow could save the homeowner's bacon in this example. If the non-payment is coming from the mortgage company, guess who's liable for the non-payment? If the homeowner was the one paying the bill, they would still be on the hook for that loan amount that is now not being paid by insurance. Escrows cost the homeowner nothing. There's no service charge or anything to utilize the escrow because it's win-win for all involved. It just protects the collateral, also known as your house. So even when escrow isn't a required feature for a loan, I often will encourage it anyway. It's insurance on your insurance, and you aren't trying to come up with a large amount once a year to pay these bills. It's coming out a little bit at a time, month after month, all along. In summary, escrow and prepaids might seem complicated at first, but they're actually designed to make your life as a homeowner easier. By spreading out your expenses over time and ensuring that they're paid on time, you can focus on enjoying your new home without worrying about bills piling up. Next week, we're going to talk about closing disclosures. Preliminary, initial, and final CDs are all important. Let's talk about what they are and distinguish the differences between them and how they apply to your transaction. We'll discuss the regulations and rules that we're required to follow as your lender, and we'll go over what you should expect when we get to that step in the process, just before closing. Like this content? Like and subscribe, and thanks for watching. If you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more tips and tricks for first-time homebuyers. As always, if you have any questions, feel free to reach out to us. We're here to help, and we love hearing from you. We're the Mortgage Dream Team. Until next time, happy house hunting.